Hello, Assalamu alaikum. My name is Danish Kazdar. I am a fellow member of ECC. Today is a very exciting session. We would be discussing accounting in a nutshell. What is financial accounting and how it can be an overview in, I believe, in less than 10 minutes. So, jumping into the financial accounting, you first need to understand the types of businesses. What kind of business are you operating or are you working for? For example, the sole trader is a person who operates a business just through himself. It could be a barber or shopkeeper. So the accounting of a sole trader would be different. Then there is a partnership. Then thirdly, there is a limited liability company. So the way of accounting changes to some extent with respect to the types of business. Secondly, there is the basis of accounting, which are the called elements of financial statements. Those are basically assets, liabilities, revenue, equity, and expenses. So these are the items which are recorded in the balance sheet and in the income statement. Balance sheet is basically assets is equal to capital plus liabilities. So your assets are basically a breakup of your own money and the money which you borrow, which is the liabilities. So uh, these are just I just mentioned three things: assets, capital, and liability. The other two things are the revenue and expenses. Revenue is also called sales, and expenses. So revenue less expenses is the profit or loss. So this is known as the income statement. Accounting is done on basis. The basis of accounting is are the accounting conventions. So accounting conventions are basically some rules on which the transactions need to be recorded. Firstly is the accruals. Accruals means that the transaction is recorded on the basis when it is incurred and not when cash is received or paid. This means that the transaction has to be recorded when it occurs. For example, a utility bill, electricity bill, for example, needs to be recorded in the relevant month. The payment can be made after 1 month or even 6 months, but the expense need to be recorded in that particular month. This is called accruals. Second is the going concern assumption, which means that the financial statements are made on the basis that the entity would continue for the foreseeable future. Uh, and there are other concepts also, for example, materiality. Materiality means that information is material if it influences the economic decisions of the users of financial statements. So these are the basic accounting conventions which you need to know about. Then the accounting, the crux of the accounting, the ledger accounts and the double entry. So basically for every debit there is a credit. So there is a method in accounting which we call the double entry system, which means that the transaction is recorded as a debit and a credit. So for example, if you buy an asset on cash, this means that the asset is also increasing but the cash is decreasing. So the asset increase is known as debit. It is marked as debit. So asset, for example, you buy a table, so the table or the furniture would be debited and you are paying cash, so the cash would be credited. If the same transaction is on a credit basis, if you buy the furniture or whatever item on a credit, the debit part would remain the same because you receive the asset, so asset would be debit and the credit would be accounts payable, which means that you are booking, recording a liability, and a liability increase is denoted as a credit. And similarly, the sales, income, and liability, they all share the same features, which means that increase in sales or liability or income or equity means that it is a credit, and an increase in expenses and assets means that it is a debit. Fourthly, we would now be looking at the procurement cycle. So accountant is required to record transactions on the basis that basically the accountant releases the payment that the procurement cycle has been followed, which means that there is a purchase request, then there is a purchase order, then there is a whole cycle which the accountant needs to know prior to releasing the payment. Then we have a concept of account payable and account receivable. So these are control accounts, and under these accounts come under the relevant individual balances, and individual vendors and customers are mentioned. Then there's a concept of sales tax. Sales tax means that it has there's a type of sales tax which is input and output. Output sales tax is when you are selling things, and you are uploading a certain percentage of sales tax on your sales, and that sales tax is basically payable. So, and the input taxes which you pay on the purchases, so that is called as sales tax receivable. Then there is a concept of inventory valuation. The inventory which you are holding in your warehouse, that has to be valued. So the valuation method is either FIFO, first in first out, or the average method. First in first out means that the inventory which was bought first needs to be taken out first, and the costing would also be applied in the same manner. Then we discussed the IAS 16. I have a separate video on IAS 16, which means that how the capital expenditure, property, plant and equipment are accounted for. Then we have IAS 38, the intangible asset, which means that how the intangible assets would be recorded in the financial statements. Intangible assets are basically assets which do not possess physical substance but which are recorded based on the recognition criteria of ISB, which means that the economic benefits are certain, and that the expense, the amount can be measured reliably. Then we have IAS 37 provisions, contingent asset, contingent liabilities, and we would discuss the provision. What is a provision? Provision is a liability of uncertain timing or amount. What is a contingent asset and what is a contingent liability? These are subject to a condition, which means that the asset is contingent upon certain condition being met, and same goes for the liability. Then we would be discussing discounts. Then there is an important concept which every accountant would be performing in his daily routine, or you can say a monthly basis, which is called bank reconciliation. So for every month there would be a different the bank balance and the cash book balance would always differ, and the reason for these differences are the timing differences between that time. Those timing differences are basically the unpresented checks and the outstanding lodgements. So the bank reconciliation is performed to overcome those differences, and so the company can know is the actual what is the reason behind those differences. ISAC accounting policies talks about the different accounting policies, and basically it talks about the errors and how the errors can be adjusted in the current period. So for example, prior period errors are dealt by adjusting the retained earning balance. Incomplete records, basically the accounting equation has to be used in order to determine the missing figure. For example, if you are given the figure for asset and liabilities, you can always calculate the capital figure. Margin and markup, again, these are concepts which would be used in these incomplete records. Margin is a percentage of profit which is mentioned as a percentage of sales. So basically a markup is the profit mentioned as a percentage of cost. And of course the very important topic, shares and its types. What is share capital? What are the types of share capital? So we have the authorized share capital, we have the called up capital, we have the paid up capital, we have these different types of capital and how these are presented in the balance sheet. Then there is a share premium and reserve concept, and then we have sources of finance, which means that the finance is the company gets finance from various sources. As you learn in the accounting equation, the company has its capital and its liabilities. So the sources are, in a very broader sense, are equity and debt, but we would be further breaking down in terms of in light of the pecking order theory, which states that the internal sources are easy to be used for the company, and the risk level increases as the company moves towards the outside sources. For example, the highest risk is associated with the ordinary shareholders, and the lowest risk is with the company's own retained earnings. So this is the crux of the accounting, and which we would be discussing lecture wise in our lectures. Thank you.